Okay, great. We are now live. People are starting to come into the webinar room, so we will go ahead and get started here at the top of the hour. Hello, everyone. Thank you for joining us today for the Institute for Energy Economics and Financial Analysis, or IEEFA's latest webinar on LNG. Today, we'll be discussing how international turmoil is creating new risks for Canadian LNG. As Middle East tensions continue to fluctuate, Canada's LNG industry faces a new and riskier market landscape. Years of volatile prices, unreliable supplies, and market crises have suppressed Asia's appetite for LNG. Many Asian economies handled the Strait of Hormuz crisis by cutting LNG imports and speeding up adoption of renewables. However, global LNG supply is poised to grow faster than ever, especially if Persian Gulf production ramps up output as expected once the Strait of Hormuz is stabilized. Canada's LNG industry is hoping to launch new export projects, but they may open at a time of weak demand, overabundant supply, low prices, and weak returns for investors. Today, we'll hear from our experts, Christopher Doleman, Clark Williams-Derry, and Mark Kalegha, who will present for about half an hour, and then we'll use the rest of the time for Q&A using the Q&A function. If we don't get to all the questions, or if something is out of scope of this webinar, we're happy to follow up with you offline. We're currently recording, and we'll share the link to the recording and the slides that everyone presents following the webinar to everyone who registered. Now to our panelists. First up, we will be Christopher Doleman. Christopher is an LNG and gas specialist on the Asia team, focusing on the economic, financial, and climate implications of developing the natural gas value chain throughout Asia. Christopher previously spent 5 years at the Asia Pacific Energy Research Center in Japan, identifying collaborative opportunities across Asia Pacific Economic Cooperative, APEC members, to achieve common energy goals. As a former market analyst and energy modeler, he analyzed how developments in policy, energy markets, and technology shape energy systems and affect energy security. Following Christopher will be Clark Williams-Derry. Clark focuses on the finances of North America's oil and gas industry. His areas of expertise include North American LNG export projects, global LNG market trends, the long-term financial performance of North American oil and gas companies, particularly fracking-focused enterprises, and financial issues related to the cleanup of oil and gas infrastructure. Prior to joining IEEFA, Clark served for 15 years as the research director for Sightline Institute, a multi-issue think tank. Before that, he worked for Environmental Working Group, Grist Magazine, and the National Audubon Society. And finally, we will have Mark Kalegha bringing it all home. Mark covers the oil and gas industry in Canada with a focus on project valuation, capital budgeting, and capital structure analysis for upstream, midstream, and downstream entities. Working for close to a decade as a finance professional in the upstream E&P space, Mark garnered firsthand insight into the intersection of community, environmental, government, and private business interest in the global oil and gas industry. He has authored and contributed to numerous published reports as an equity research analyst and institutional clients on investment recommendations and portfolio optimization. Okay, so without further ado, I will share Christopher's presentation and I will kick it over to him.
Thanks for the introduction, Susan. So yeah, I'm not going to spend too much time talking about the volatile situation in the Persian Gulf, but I think suffice it to say, the strait appears to remain closed. That's locking in 20% of global LNG supply, off from Asian buyers that are heavily reliant on it. I know Qatar Energy is not optimistic about restarting deliveries through October. An expansion appears to be on hold. And, right now, spot prices for LNG are double what they were before the crisis. Oil index LNG is about 50% more expensive. So, this is making it challenging to find affordable replacement cargoes. And we don't have a detailed global LNG model at IEEFA, but, we are picking up signs of what would be categorized as demand destruction. Next slide, please. So yeah, full disclosure, I think it's been our view for a while that LNG is facing an uphill battle in Asia. I think many assume that demand in Asia is latent. When the supply arrives, demand will rise too. But What we've seen is LNG is a luxury fuel. It's existing in a just-in-time logistical system governed by a volatile global commodity market. Securing LNG isn't a problem if you're wealthy, like European buyers, Korea, Singapore, Japan. But if you don't have that wealth, it could get very expensive to secure cargoes in your home currency. And that's particularly true in emerging markets whose currencies tend to depreciate during crises. And yeah, for that reason, I mean, LNG imports in Southeast and South Asia tend to be very price responsive. I mean, also this decade, we've seen imports from major buyers like Japan and China plateau or even decrease. We're seeing rise in renewable deployment, reduce gas use across the region. And, just last year, we started to see heavy duty gas turbine bottlenecks start to increase the lead times and cost of power projects, derailing their development across Asia. So while industry's counting on Asia, to rapidly grow in terms of demand to absorb new supplies, I mean, as you see here, demand's been pretty flat, moving sideways for most of the decade. And I'd argue that the energy crisis that started this year is exacerbating all these issues. Next slide, please. See, we could talk about supply a bit. I think everyone's expecting more LNG supply to commission since Iran's demonstrated how easily they could close the strait. I think we're starting to see a FOMO rush from suppliers, to use this crisis as an opportunity to get projects built, export projects particularly. I think the collaboration between industry and government in Canada to fast track projects is pretty illustrative of that. Buyers that rely on the Persian Gulf for LNG are looking to escape the brunt of spot price volatility. So many buyers are now in the market. They're looking for diversity, redundancy, flexibility, particularly from supply sources that are less likely to be disrupted, by blockades or conflict. So we're seeing a security premium start to maybe unlock supply that otherwise may not have been viable prior to March. Of course, it's difficult to see this in the data yet in terms of contracts that I'm showing here because it could take months to negotiate a legally binding commitment on either side of a contract. But in the contracts that we've seen, we're still seeing a lot of speculative or trade-driven activity. This decade, most LNG contracts have been signed by portfolio players that are speculating on their ability, to make a market for their commitments and basically find an end user. But this year, 38% of the contracts signed are by such portfolio players. They haven't found a home for the LNG yet necessarily. And while Asian buyers are making up, over half of the commitments so far this year, 39% of the Asian commitments are by companies trying to grow their LNG trading footprint. So it's not really clear that, this LNG has a definitive home yet either. If, Thailand's PTT and Japan's JERA are making up 39% of those commitments. Next slide, please. And again, yeah, just sort of a reminder, LNG proponents, since, this is from around 2020, but it's sort of the same argument that Shell's making today. They're counting on emerging Asia markets to absorb their supply. And a general driver of this thesis is that rapid demand growth is required to replace declining domestic production, displace coal, or to back up growing renewables in the region. Next slide, please. But our experience has sort of demonstrated that that's not really true, just based on what's happened. I mean, Asia is filled with price-sensitive buyers that are either going to leverage their alternatives to reduce their LNG exposure during crises or get priced out of the market entirely. Speaking about the coal displacement issue, if you want to compete with coal in Asia, that probably requires the landed cost of LNG to fall into the $6 per MMBTU range and sustain that level so that potential buyers can respond to the price signal. It's true that several gas markets in Asia have gas resources that are, in decline. However, if you built an industrial economy on legacy gas costs that are in the $2 to $5 per MMBTU range, export-oriented manufacturers aren't going to be able to survive if that cost rises to LNG levels, or they're going to need a lot of subsidization to make it happen. In Pakistan, we've also seen how exposing grid electricity to LNG markets could lead to a consumer-driven energy transition, by installing rooftop solar panels to defect from the grid. Pakistan's imported about 50 gigawatts of solar panels over the last 4 years. That could generate enough electricity to offset between 8 and 10 megatons of LNG. Last year, Pakistan was overcontracted with LNG because of this. And I think this debunks the notion that surging renewables will drive LNG growth. It can actually displace it. And, across Asia, we're also seeing industrial consumers want to reduce their energy costs to improve competitiveness. So there's a strong interest in rooftop solar direct power purchase agreements with potential solar producers. And because of that, I think it'd be a mistake to assume, that this market is going to be latent with such an expensive, volatile commodity like LNG. Next slide, please. Yeah, and in Asia, many countries are realizing that you could be getting a lot more value out of the expense that LNG requires. If you embrace low-cost solar, you could obviate the need for a recurring LNG expense and put that money towards helping alleviate the impacts of other parts of what is a multi-commodity disruption that we're experiencing right now. Next slide, please. And this crisis, I think we've seen a stronger embrace of renewables. I think there's several reasons for that. I mean, the cost of Chinese solar panels is halved over the last 4 years. Um, there's also learning from what others are doing. We've seen many power markets demonstrate that you could use solar combined with batteries to reduce gas peaking requirements. And right now, you could actually do that at a levelized cost that undercuts LNG-fired power generation. The other benefit, speed. I think everybody wants power supply to meet rising demand, but nuclear takes decades. Large-scale natural gas power plants could take 5 to 10 years. Solar could take 1 or 2 years, and rooftop even quicker. So I think there's this understanding occurring, during what is the second crisis in 4 years, and governments are now starting to increase their policy support and renewable ambition. We've seen import duties on solar panels removed in Cambodia. We've seen tax incentives for rooftop adoption in Thailand. We've seen more ambitious renewable energy targets in Korea and Pakistan, all since March. Also, China has exported 34 gigawatts of solar panels across Asia in the first half of this year. That could displace 6 or 7 million tons of LNG. And if you start to pair that with batteries, that offsetting power could start to climb, or start to maybe double or treble. So the value, and also if you see here on the chart on the right, the value of battery trade from China is up 61% in the first half of the year. So maybe we're going to see some of that later down the line. Next slide, please. And also since March, there have been notable proposals by Asian countries, which include project cancellations, nuclear restarts, general repurposing of LNG to power projects into renewables that could potentially destroy 16 million tons of demand. That's basically the combined capacity of LNG Canada and wood fiber. Next slide, please. So yeah, I just want to end by showing you like some quotes from LNG executives, and I just want to, or like gas executives, and just highlight that this isn't, just the climate nonprofit CSO space saying this. Industry is concerned. They know that the energy crisis is damaging LNG's reputation as a long-term, secure, affordable energy solution. They see the risks to the viability of their business model. And I think right now we're enduring a period of cognitive dissonance where buyers are looking for new supply, to diversify away from the Persian Gulf. But at the same time, the relative energy security benefits of renewables are going to continue to push down the long-term trajectory of demand. So I think this is setting ourselves up for maybe a deeper glut later this decade. And I think the timing is going to depend on how quickly the Hormuz situation is resolved. I think with that, it's probably a good time to pass it over to Clark to talk about that. Thanks.
Thank you, Chris.
So let me share my screen if I may. Can folks hear me okay? And can you see my screen? Great. So thanks, Chris. Chris has obviously just walked us through the demand side of the market, and in particular, the weakening and uncertain LNG demand we're seeing in Asia, which is the very market that the global LNG industry needs to grow quickly in order to meet its financial goals. And remember, that's true not just for the LNG industry writ large across the globe, it's particularly true for Canada. I'll be focusing more on the supply side of the market. Uh, and I'm going to start with what may be the most boring chart I've ever shown in a webinar. It shows the blue bars represent LNG shipments in the first half of the year. That is from January 1st through June 30th for the last 6 years, 21 through 26. And what you see is, well, it's just sort of slow, steady growth in output, roughly 2% per year, about 11% increase since 2021. But the reality is that this sort of steady as she goes like story actually conceals two dramatic shifts in what has happened in the LNG market and the LNG supply over the course of this year. And to show that, I'm going to show that same chart, but I'm going to break it down by region. In red, we have what's coming from the Persian Gulf, what flows through the Strait of Hormuz. That's Qatari and UAE output, United Arab Emirates output. And that's in red. And in blue is the rest of the world. And what you can see pretty clearly is that in 2026, there have been two dramatic shifts. First, the red has contracted. That is, the closure of the Strait of Hormuz from the beginning of March on, or the end of February on, has really bottled up a tremendous amount of supply globally. But at the same time, the rest of the world has responded. We saw a 58% output cut from the Persian Gulf, but that has been more than counterbalanced by the growth in the rest of the world supply. And that's not just one project, it's multiple projects. It's the US. In the US, there's the 13 million ton per year Plaquemines project in Louisiana. There's been 7.5 million tons per year added in at Corpus Christi in Texas. Obviously, there's the 14 million tons per year of capacity that was added at LNG Canada. I've also seen ramp ups of output in other parts of the world, Russia, for example. Just to be clear, there's a small portion of this that is related of this sort of ramp up in rest of world output that is related to countries and individual facilities running their facilities a little bit harder to get more revenue during the crisis period. But that's only a small share of this. It's mostly this blue expansion of the blue supply is mostly due to rising output from new facilities. But the thing to remember is that we are still just at the early stages of the build out, the sort of increase in capacity that has sort of allowed the global market to weather last year or this past 6 months. Uh, that is just the start of the amount of new supply that's going to be coming online around the world over the next 5 years. We're going to get additional contributions from a plant in Mexico, Energía Costa Azul, just 3 million tons. It just came online. Same for a train at Golden Pass in Texas. There's going to be 5 million more metric tons of capacity this year or early next from in Australia. We're going to see new capacity over the coming years in Argentina, Gabon, Indonesia, Oman, plus obviously the wood fiber and cedar plants in Canada. So all told, through 2031, we expect most of this capacity, or the largest share contribution to new capacity, coming from the U.S. It's about 130 million metric tons through 2031. The red bars is again that's Qatar. That could get delayed because of the turmoil in the Strait of Hormuz and the Persian Gulf. We haven't yet updated our forecasts of when that's going to come online, but it would really just sort of push things out, likely in the most likely outcome, push things out by 6 to 18 months. Uh, this is another way of looking at that same tidal wave of new supply that is coming online right now. If you look, at the last few years, 21 through 25, you have a significant growth in output, but coming online over the next few years, we'll see growth rates that are 3 times as fast as they were in the prior 5 year period. Now, this is going to create a real challenge for the market that, how low will spot prices have to go in order to clear this market? I mean, this is a market that is all right now. The prices are high, but we're not seeing the same level of price spikes we saw during the Russian crisis, even though the volumes affected by today's crisis are quite significant, and that's because of the new supply coming online. But how, as this new tidal wave of supply comes online and meets this sort of like this resistance from Asia and the weak demand growth in Asia, how low are prices going to have to go to clear the market? Well, we don't have firm answers on this. The futures market does have an opinion. Now, it's you have to be careful with futures markets because the futures market is not an accurate predictor of futures prices. It's just sort of what the market currently thinks is going to happen. But right now, futures prices show show a drop in LNG prices through the next 5 to 6 years, particularly through 2028. We're starting to see prices in Europe dip below $10 per MMBTU by then, and they approach $10 per MMBTU, and then fall from there over the following years. Now, this curve could change and does change dramatically depending on what's happening in the Strait of Hormuz. And we could believe that prices could fall sooner and faster if the Strait of Hormuz opens quickly. Conversely, they could stay higher for longer if Hormuz stays closed for a long time. But regardless, this is the sort of the consensus view of what's going to happen in the markets about, over the next few years, showing that the prices are going to fall, and it raises questions. High cost LNG suppliers, whether they're high cost LNG plants or if they're portfolio players who've committed to buying high cost supply, they are at risk of losing money if they try to sell into weak spot markets. Okay, so I'm just going to conclude with a few sort of summary conclusions and implications for the LNG market. First, clearly, rapid supply growth in LNG output around the world is poised to send global LNG prices lower. And this tidal wave of new supply is going to collide with years of weak demand growth, particularly in Asia, which is the region of the world that the LNG industry is counting on for robust growth in order to meet its financial goals. The LNG industry is actually hoping, as a result of this oversupply, that low prices will eventually lead to more demand. However, the tensions and the continued turmoil we're seeing in the Persian Gulf could lead to higher and more volatile prices due to geopolitical tensions, which have the potential to further suppress demand growth. Meanwhile, as Chris mentioned, renewables are, if you're looking for a supply of new power, they're cheaper than gas, they're faster than gas, and they're gaining ground in both Asia and Europe. So what we expect to see over the coming years is LNG producers and traders trying to use politics to stimulate gas demand and suppress alternatives like renewables in the markets that they can have some influence in. So I will pause there and hand things over to Mark.
Thanks, Clark. Okay, so I am going to bring this into Canada after seeing what Chris and Clark have put forward and try to draw some conclusions. What does this mean for the Canadian LNG industry and the current build out, as well as look into some implications from the current conflict in the Middle East, and what does that mean for Canada's LNG industry and what's going on over here right now. Next slide, please. I start with going into just to take stock of where we are in the Canadian LNG build out. There's currently one large scale LNG exporting facility operating in Canada today. That's LNG Canada Phase 1. Was commissioned about a year ago. That's located in British Columbia, obviously. Under construction, we have two facilities, Cedar LNG and Woodfibre. Cedar has a target date of 2028, and it's said to be about 50% complete. And Woodfibre, late 2027, said to be about 60 to 65% complete as that last reporting dates. In addition to those facilities, we have proposed facilities in Canada, which is there are a long list of proposed facilities over the years. The IEEFA North America LNG tracker went into details listing multiple facilities over the years that have encountered various challenges and didn't move forward. The list is quite long. Here, I just have a short list of potential projects that we could say perhaps have some sort of traction. LNG Canada Phase 2, because there's already existing infrastructure from the Phase 1. There's already ownership looking to push that forward. FID for that project has not been taken, so it's not certain that it's going forward. FID is expected this year. We have the Sea Sims project as well. There's no FID on that project yet. There are significant hurdles with the lack of a feeder gas pipeline or the PRGT pipeline for that project. There are also some sales and purchase agreements that have been signed for that project, but not these are not enough to take care of what the capacity of that is meant to be. There are a few, but they're still quite significant, or majority of the volumes are not signed up by buyers yet. There's also the Tilbury expansion. This isn't necessarily an export project, more domestic, focused on marine fuel, but that is also on the table going forward. So we have that short list. There are a long list of projects. On most of these projects are concentrated in British Columbia and the West Coast, but there are projects that are being proposed and discussed in multiple provinces all over the place. Next slide, please. Essentially, we have where we are right now is there's that initial LNG Canada phase one operating, and Canada is looking to explore expansion into a second wave of LNG projects. That expansion drive is much talked about, but there are some emerging headwinds that these projects face. In addition to the structural issues, which have been discussed extensively by IEEFA and other market analysts, which include cost competitiveness and high costs for projects, as well as infrastructure deficits in the industry and opposition from various stakeholders. We're having issues, we're seeing issues with environmental concerns and gas flaring issues that are affecting the inaugural LNG Canada phase one. These have been well documented and well reported on. I initially thought these were short-term teething problems with that facility, but it looks like the gas has exceeded what they planned or what is routine, and these are looking like structural problems. So that raises questions from the industry and stakeholders about what are the health effects of on this on local communities, and that's also well documented. This is the industry presents itself as having a low carbon business model and is supposed to provide low carbon LNG, at least on paper, but the experiences from the first project has a lot of questions to be asked regarding emission levels and what that means for a build out in the future. In addition to that, we have issues with the pace of contracting. There, like I said, there have been limited, next slide, please, limited amount of contracts for these proposed projects. A great majority of the projects on the list don't have buyers secured, and LNG development is very capital intensive, requires a lot of debt, and lenders want to see these definitive signed sales and purchase agreements before they agree to finance these projects. So this is another impediment for the build out and the long list of proposed projects. Out of the short list that I presented on the first slide, about 48.5 metric tons per annum of LNG capacity, only about 26.3 have some sort of contract for buyers. About 21 to 22 metric tons have no buyers, and most of those contracts are in, I mean, if you look at LNG Canada phase one, that's about 14, and then you look at Cedar and Woodfibre that are under construction. The rest of them have no definitive buyers for this product. That's going to be an impediment for FID decisions going forward. So that's something that we need to take a look at or keep an eye on. Next slide, please. Going after that, we looked at the Iran conflict right now and the geopolitical turbulence in the Middle East and what are potential transmission channels and what does that mean for Canada's LNG industry ambitions and the build out. These are not necessarily definitive forecasts because that situation is very volatile, and the only thing certain is the high level of uncertainty. When we're preparing for this webinar, when I was at some point, it looked like that conflict would be resolved and they signed some MOU. And then right before this holds on, there's a further escalation. And now not just the Strait of Hormuz is closed, but we find now that the Red Sea is also having some obstructions, which runs parallel to the Strait. So who knows? These are just potential impacts that this conflict could have on Canada's LNG build out. The first thing we know is prices are up, prices are double, And what does that mean for the industry? And in event that prices are higher, does this increase investor interest, or does that have the potential to make investors more willing to finance these projects that have been proposed? And also, what does the high prices, the volatility, and the supply disruptions mean for Asia, which is a key target market for Canada's LNG industry and the build out projects that are being proposed? What does that mean for the Asian buyer and the Asian consumer? Next slide, please. Uh, the first thing that we can say is prices are up, so someone's going to make money. There's going to be windfall gains for certain LNG producers. In Canada, there's only one, like I said, producer. So LNG Canada will definitely see increased revenues. And insofar as government royalties are derived off the top line of revenue, there should be an increase in the government take as well. However, the infrastructure limitations and how long it's going to take to scale production will limit what sort of windfall gains that the industry can expect to attain from the current price environment. Projects are at least 2 to 3 to 5 years out before they could actually start producing into this market. So that limits how much production could be ramped up. And the gains are not spread evenly because what we're seeing, in addition to LNG prices, is a broad-based increase in energy prices. And if that starts to show up in inflation in a more material way, we see the CPI, which is a measure of inflation in the economy, rising. So that affects consumers negatively because now you have a less share or higher share of your disposable income going to energy prices, buying gas, and businesses as well. Transport, logistics businesses have to spend a lot more money on that. And further, if the CPI continues to trend up, depending on the duration of this conflict, you might have central banks react via monetary easing or monetary policy, which could include either raising interest rates to try to slow down inflation in the economy or reducing the level of easing or the rate of easing. That affects the cost of borrowing in the broader economy for consumers, as well as the very LNG projects that we're discussing right now, because these projects, like I said, depend on leverage and a lot of debt, and increases in interest rates would certainly increase interest expense that would be required. So if we see this inflation seep into the economy and interest rates start to go up, that could also have a negative drag on potential projects and profitability and FID projections. Next slide, please. Another thing that we thought about is these prices are double right now, and naturally investors might be thinking this might be a good time to push some of these projects forward to try to take advantage, because if you have a proposed project where LNG prices are $7 per MMBTU and you have your economics, and then you have an environment where prices are double that, certainly one might think this makes it a more profitable project and there'll be more interest and more potential. However, I think that because the industry is, for example, LNG Canada, Cedar, and Woodfibre all have 40-year natural gas export licenses. It's a long-term industry, and there is no guarantee that this current price environment is going to last for that long, or even more than a couple years. Like Clark showed with the futures price projection, the market is expecting prices to trend lower in the near future. We also have all of that capacity that's been waiting to come online in the near future. And the next projects in Canada are 3 to 5 years away. So there's also the potential that this conflict gets resolved in one way or the other before those projects come online. And if that does happen and the strait is reopened and we see some more normal gas flows through the Strait of Hormuz, we expect prices to trend down and all that capacity to come forward. So what may look like a profitable environment right now may not last that long into the future enough to impact current projects that are producing or proposed projects who may target that window. So we see this as more of a transient premium that might regularize in the near future. And in that case, projects that want to take advantage of this may not really be able to. So we don't see that as a catalyst for future projects moving forward. Next slide, please. Looking at the longer term effects of the crisis, that's even more uncertain. One viewpoint is that this is the second energy crisis that Asia has had to face in about 5 to 6 years with all the volatility. If you are in charge of a supply chain or an energy minister in a key Asian country, you probably are, and they are saying this, and we are seeing policies and some data saying that they probably would try to reduce their reliance on volatile Persian Gulf, or at least diversify some of that supply. And with that line of thinking, buyers may want to target less volatile supply jurisdictions or supply regions that are less likely to be disrupted by geopolitical conflicts and less likely to be disrupted by any sort of war or internal wranglings. And in that case, Canada and British Columbia supply may become more interesting to certain buyers around the world. And we have this shelf of projects that are being proposed, and Canada has a reputation to be relatively stable. So these could become interesting. However, if that is the case, we expect to see an uptick in sales and purchase agreements being signed going forward. That is yet to show up in the data as at today. I think Chris said these usually take a couple years to negotiate and finalize. So that's a key indicator that we will be keeping an eye on going forward to see if there is an uptick and if Canadian LNG is becoming more sought after in the market. But as at today, the data does not really support that yet. Another potential long-term implication of the Iran conflict is some of the demand destruction and some of the demand shifts and the efficiency improvements that are being undertaken right now in Asia due to the necessity of having to make up for the disruption. These could end up moving from temporary to more structural and permanent measures. For example, LNG was championed in Asia as being stable for electricity production and unaffected by fluctuation with the sun and the wind. Well, tell that to importers and factory managers and ministers who have had to deal with this reoccurring conflict for the second time in about 5 to 6 years. The price volatility, doubling prices. You have buyers that have budgets that have been set years before, and they have shareholders that are reporting to, and then all of a sudden the key cost component doubles, and they have no control, they have no say, and they're not parties to this conflict, and they probably were not consulted. And so this is certainly something that is not that they're probably not really happy with and would try to prevent from happening in the future. We're seeing talk from high-level executives, politicians, government officials about Asian economies rethinking import dependence and trying to focus more on self-reliance so that they're not in this position again. Minister of Energy in South Korea says the war serves as a significant turning point, and there's a growing national consensus that they must undergo a fundamental energy transition. So that's probably the sort of thinking that policymakers in Asia are going through right now, and they're setting ambitious targets and incorporating renewables in their energy mix. And there's doubt whether a lot of Southeast Asian, and some of the poor, less resourced economies will go ahead to invest additional money in LNG import infrastructure. And if we look back in history, there are some parallels between today's conflicts and in the past. In the past, with the oil industry in the 70s, you had the Arab oil embargo on Iranian revolution, and it was a similar situation where supplies are disrupted, prices double, or even triple in that scenario. And in response, there was scarcity and people had to make do with alternatives, demand destruction and efficiency. And that was a severe shock. And what happened, some analysts have observed what happened in the aftermath of that conflict was the growth in oil and the electricity mix reversed considerably. And global oil demand per capita actually peaked around that time. And oil share of global electricity went from 25% in the 70s to about 2% today. So those demand patterns went from being temporary to more permanent. Now, no two crises are like in history, they say doesn't repeat itself, but there is a possibility that in the aftermath of this conflict, we might see more permanent shifts in demand patterns in certain Asian countries. The scale of disruption today is significant. There's a lot more substitutes available with renewable energy. And there's also a lot of concern about these reoccurring conflicts and the threshold for disruption with these cheap drones seems to be reduced. So there's a lot more uncertainty. So there is, like I said, a possibility that this crisis would accelerate the shift away from fossil fuels, and that could limit the growth of the LNG market that proposed projects in Canada and the industry is hoping to sell into in the future. Next slide. So just to put a brief summary on what we're trying to say is today, Canada is at an inflection point. We have one project that's up and running, and there's a second wave of projects that are being considered to move forward. The Iran crisis and the price premium we're seeing might create a windfall for a certain producer, well, one producer in Canada, and but that is unlikely to shift the project economics of the multiple and the plethora of projects that are being proposed that are waiting in the pipeline because we don't see that premium lasting. And while the geopolitical turbulence might increase some demand or interest in Canadian LNG, being that it's perceived to be stable, certain demand responses, policy shifts, and availability of substitutes and the rise of renewables in Asia may actually alter the growth trajectory of LNG in the global markets and limit what kind of market that LNG projects could sell into in the future. That's it for me. Thanks.
Great. Thank you, Mark. Thank you to all of our presenters for that great information. We have started to get some questions in the Q&A. If you have others, please put them in there, but we'll get started with the ones that are in there right now. The first one is, could you comment on the role of offtake agreements? Clark, do you want to get us started with that one?
Sure. If by offtake agreements you mean companies or utilities that are agreeing to buy, or traders who are agreeing to buy LNG supplies over the long haul. Those are often the sort of the underpinnings, the financial underpinnings for a project to reach FID. When you have a solid contract that's over a long enough term and at a good enough pricing with a creditworthy counterparty. And you kind of have to have all of those: long time, creditworthy counterparty, enough volume, enough price. That can provide some security to lenders that regardless of what else happens in the market, that LNG project will get some revenue over the long haul. Now, there are problems with this because if you have a bunch of offtake agreements and some are with creditworthy counterparties, like let's say it's called Shell or some other big company, and you have some that are with smaller companies. Maybe it's a smaller utility in a part of the developing world. Lenders are going to have to be sort of judging the quality of the overall portfolio of offtake agreements before they are willing to lend money and before they're willing to set the price or the interest rate at which they're willing to lend that money. So again, offtake agreements are often sort of the financial underpinnings of future LNG development because it sort of guarantees revenue. But just because you have offtake contracts doesn't mean you will get funded, because it depends on the quality of those contracts. Hopefully that answers the question a little bit.
Great. Thanks, Clark. Does anyone else want to chime in on that one or move in? All right, keep moving on. Okay, next question. Does global lower prices also mean it will be a buyer's market? So more ideal for countries focused on imports, but bad for countries focused on export.
I can hop on that one too if you want, or Chris, you might have some, or Mark, you might want to correct me if I if I stray. So in general, yes. I mean, if you have a buyer's market, that generally means that prices are low and buyers can secure secure cargoes of LNG at a price that they find acceptable. The challenge here, though, is that the closure of the Strait of Hormuz and the potential for repeated closures of the Strait of Hormuz could create sort of shockwaves through the LNG economy for years. That is, we can't know now whether there's going to be a permanent resolution, or maybe the Strait of Hormuz will be closed periodically, moving forward. In which case, two things happen. One is the supplies remain volatile, and so it's not really a buyer's market when when the buyers can't count on supply. Alternatively, you could wind up with what's called a geopolitical risk premium. That is, uh, buyers paying a little bit extra to buy LNG, that is for basically LNG spot prices, because of the risk of losing the supply from the Strait of Hormuz. So both of those things do suggest that prices could remain higher than they would otherwise, and they remain more volatile than they would otherwise, which tends to suppress demand. So if you have prices go down low enough, yeah, of course that's a buyer's market, but we are now in a situation where there's enough uncertainty in the Strait of Hormuz and what that's going to mean moving forward, that it maybe is not as much of a buyer's market as you might think because of all the uncertainty. Is that, Chris, do you have any, or Mark, do you have any thoughts about that?
I think the only thing I'd add is, a lot of buyers in Asia were sold that LNG was a secure, affordable fuel in the 2010s when prices were low, like under $10 per MMBTU during the last period of oversupply, and that's how a lot of them started to build it into their long-term power and energy plans. But I think we're starting to see that, the two crises are sort of scaring them away. So yes, so obviously lower prices are good for buyers, but I think they're saying, shame me once, shame me twice sort of scenario. And yeah, like even this week, I think I saw in the New York Times quotes from the CEO of Morocco Power Gen saying, we're rethinking the role of LNG and our energy mix because of this volatility, despite the fact that, prices might get low. And, so what that means is, they might all hands on deck to try to minimize your reliance on it. Renewables are going to play a role. Right now, the Philippines is the largest market for solar panels in the world, I believe, or at least for one quarter this year was. There's also, trying to explore for domestic gas production to, reduce the need for LNG imports. And of course, coal could play a role too, since it's cheap. No.
I
Great.
guess I think it's a really interesting question about what is going to happen in the future. It's hard to know, but what we are seeing right now is signs that the so-called buyer's market may not be uh, incentivizing the kind of demand growth that the LNG industry is hoping for.
Great. Thanks, everyone. Next question. Can you speak or explain to how the provincial and federal governments stepping in with public dollars and or loan guarantees are essentially making the economic outlook for new high-cost late LNG projects in Canada look more favorable than they would be, given what you've presented about supply pricing? Who wants to
Um,
start?
yeah, I'll just take a stab at that. I think the government has not unlimited but significant resources and are able to finance any project. And if you include free money uh, as part of your capital mix, or at least very cheap money, you can make a lot of projects that may not fly otherwise actually move forward. So if the government is willing to finance these projects, it definitely it does change the game, and a lot of these projects might actually with the government money move forward, even if there are concerns. Uh, Another way I look at it is if the government has to step in with public money, that means the bankers and there with their models and the finance, because there is a lot of private capital out there, but if they are unwilling to put the money forward, then that says something, right? So it is a concern, and I'm yet to come across explicit plans by a provincial government to finance these projects. There will be loan guarantees to try to promote Indigenous participation, which is similar, but I think that may be limited. These are really large scale projects, at least some of them are, but it is something that can happen because of the resources, and they could push anything that they want to, but um, I'm not seeing a lot of that yet explicitly.
Yeah, I think it's important to remember, I just sort of emphasize something Mark just said, that if the government is putting money into a project, it is a sign that it is not a good project, or it is not a project that pencils out without government subsidies. And that's true for loan guarantees as well. A loan guarantee is basically a way of lowering the borrowing costs for a project, but it pushes risk onto taxpayers because if the loan isn't repaid for some reason, then it's taxpayers who are actually like, basically guaranteeing the loan. And so loan guarantees are a way of shifting risk from, basically benefits to the developers and risk onto taxpayers. It's often portrayed as not a subsidy at all, but it is a risk subsidy. It's a risk subsidy that has a monetary value to the project developers and a monetary calculable risk to the taxpayers.
Great, thank you all. Okay, next question. Is it too late to turn the ship on LNG market strategy in Canada? Market analysis, even before Ormuz, pointed to a flawed metrics behind the strategy, but yet the Canadian government has doubled down on LNG and raised oil and gas production and is counting on CCS to offset higher emissions. Or does Ottawa put the thumb screws to Canada's pension funds to finance this potential industrial misadventure? Who wants to start with that one?
I'll take a stab at it. I think that, in my opinion, ultimately is the market dynamics that are going to determine which of these projects move forward. The government has strategy, and they planning to fast track, which is permits, and try to get these approved faster and put some traction. Um, some financing, but these, like I said, these are large scale projects. They probably would have, like, I'm not sure how many of these they could back financially in a material way. So I think ultimately it is the market dynamics, the supply in the market, that are going to determine if these FIDs are taking and if these projects go forward. Um, there are a lot of hurdles that these projects need to scale with or without government backing. So I think that's just something that we need to keep an eye on and keep watching. The government is looking for ways to stimulate growth in with the global environment right now and the trade war. So they're going to lean on certain sectors to push that growth. And I'm not sure there's much that we can do about that, but it's just something that we have to sit back and watch. And regarding the pension funds, there has been talk about that, but I think the pension funds, I don't think the government is legally or has the power to direct pension funds to make an investment. They need to come to that decision by themselves based on their fiduciary duty and what they see the market potentials are, if there's a potential for return in those investments. And I think it's still challenging with the dynamics that we see right now, but it's just something we got to pay attention to, I guess. I don't know if anybody else wants to chime in.
Yeah, I do want to chime in about the CCS point that was asked in this question. Basically, the question as I see it was, is the government counting on CCS to offset higher emissions? That is largely sort of, it's a kind of a talking point that gets used all the time that CCS can help reduce emissions. Um, it kind of ignores what actually happens in some developing markets, particularly places like India, Pakistan, where significant amounts of LNG gets into the pipeline system as natural gas, and that leaks at high rates. And once you get, like you can ignore what happens in Canada. Once LNG gets into the gas system in a developing country, there's no guarantee that LNG is not going to be emitted as methane, a highly potent global warming gas in the destination countries. So a lot of the talk about the benefits of LNG for the climate, they hinge on two things. One is we're going to use CCS to offset our emissions, and two, we're just going to replace coal. And neither one really, first of all, we're not seeing any significant increase in or any decrease in coal consumption in the electricity sector in some of the biggest markets like China or India, which LNG is simply not replacing coal there. It's just not happening. And more importantly, things like CCS, sort of relevant to this question, things like CCS do not offset the emissions that we're seeing in the destination countries, particularly developing countries.
Great. Thank you, Clark. We're running short on time, so I think we will have time for one more question and then we'll wrap up. So the last question, in terms of LNG on sellers, do you have any insights on China's contracting and trading strategy and what it means for prices and demand? Chris, do you want to take that one?
Yeah, sure. Yeah, I don't know if we have like insight into the strategy explicitly. I mean, we've covered perhaps, Japan's reselling strategy, how Japan tries to handle 100 megatons of LNG a year, and two-thirds of that goes to domestic demand and a third is exported. China doesn't have an explicit government strategy saying that, but one thing I do know is like in 2025, their total contracting level was about 19 or 20 megatons above what their demand is. We are seeing like Chinese charterers start to, divert cargoes away from China into other markets at an increasing rate. And, had Hormuz not closed and some of these force majeures happen, at Counter Energy as well as, some expansions delayed. I mean, their overcontracting in 2026 could have grew even further, maybe as much as 40 million tons. And, they have a lot of flexible contracts coming on with the United States over the coming years, going to be well over 100 million tons. So yeah, they have a lot of diverse sort of energy sources that they could tap that are cheaper. And I think that's what's enabling them to do this. They're, I think, the fourth or third largest gas producer in the world, typically growing at around 7% a year, although there was like a disruption this year that might slow that down a bit in terms of an offshore field. And they also, have like a cheap pipeline imports coming in that are cheaper than LNG. They have a lot of cheap coal. They have a lot of domestically manufactured renewables. So really it's, where will that LNG fit? I think in order to fit, prices are going to have to come down a lot. And in order to compete with coal or some of these cheaper energy sources, if that's the case, I think it's going to be pretty bad for, some of these newer projects that need to compete, with China potentially a customer for, resales across the region. And Japan's also doing this. And I mentioned before, PTT and Thailand is looking to grow its trading footprint too, from about 3 megatons now to about, I think, 10 by 2030 and 15 by 2035, I think. So yeah, I think that, yeah, I guess that's how I'd answer that on-selling question.
Okay, great. Thank you, Christopher. We only have 1 minute left. I don't think that that's really enough time for all of these very great questions that we've been getting. I don't know if any of the panelists have any last parting words, but Clark has his thinking face on. So.
Yeah, I just think that one thing we didn't talk about much was the political reactions by the LNG industry to the new reality of oversupply. What I expect to happen, and I may be alone in this, but I expect that we will see continued efforts by the gas and LNG industries to promote LNG as a solution, either a climate solution, an energy security solution, even in the face of all the sort of the turmoil and the busted budgets and the high costs and the uncertainty and the unreliability. We will still see the rhetorical efforts by the industry to paint LNG as a solution for Asian energy. I think we just have to be careful about that because we are right now seeing the potential for the LNG industry to try to use its political and rhetorical muscle to change the markets. And that's something I just think we have to be all very, very cognizant of.
Great. Thank you so much, Clark. I think those are some perfect words to end on. Thank you to our panelists today for sharing this great information. Thank you to everyone for joining us and asking your very insightful questions. I will be sending an email either today or tomorrow with a recording and the slides. You can reply to that email. It'll be to my direct email, which is Susan Torres. If we didn't get to your question, feel free to reach out and we'll do our best to follow up with you. But thank you everyone for joining us today. We really appreciate it. Have a good one.
Yeah, thanks for attending.
Thank you.
Thanks.